Hi, welcome to the Lifetime Capital Gains Exemption in Canada video series. My name is John McElroy, and I will be walking you through the presentation today. We are on our third video in this series, using a holding company. Now, in video 2, we looked at a situation where you own the shares directly in an active business. In this video, we're going to take a look at you owning the shares of a holding company, which owns the shares of the active business. So the first part we've covered off already in video number 2, and we're looking at the right-hand side in this video. Now, if you own the shares in a holding company and you sell those shares and you get a capital gain, can you use your Lifetime Capital Gains Exemption? That's what we're addressing in this video. Please keep in mind that you do have to sell the holding company. I sometimes get asked that question. People think they can sell their active business and somehow qualify. No. If you sold the active business in this structure, the holding company would have the capital gain, not you. Corporations don't have a capital gains exemption. So you have to sell the holding company. You have to sell them both. But if you do, can you use your Lifetime Capital Gains Exemption? Well, it depends. Like before, we have some tests that we have to apply. The connected corporation test, the ownership test, the control test, and the asset use test. So I've set up a chart very similar to the one we looked in video number 2. Test number 1, are the two companies connected? In other words, if you own shares in a holdco and it owns shares in the active business and you sell the holdco, for you to be eligible to use your capital gains exemption, those two corporations have to be connected. Well, what does connected mean? Well, there's two possibilities. Number one, if the holding company just outright owns and controls the active business corporation, if there's a control situation in there, control being 50% plus one of the voting shares, those companies are connected for tax purposes. But there's a second possibility. If the holding company owns shares that represent 10% of the votes and 10% of the value, those two companies will also be considered to be connected. Okay? So, whether 1 or 2 applies in either case, you're going to get a check mark for the time of sale connected test. For the 24-month holding period, connected does not factor in, because we've talked about before that for the 24-month holding period, there's a person related to you type concept. So that does not apply in this case. We don't have to worry about connected over 24-month holding period. What about test number 2, the ownership of the holdco? It's a little more complicated in this video than the last one because we're talking about ownership of 2 companies, not 1. Let's start with the ownership of the holdco at the time of sale. Well, the very same rules apply that were covered in video number 2. The ownership of the holdco has to be either you, a related partnership, or a spouse in that very special circumstance where things get attributed back to you because you gifted the shares to the spouse. And if that doesn't mean anything to you, go back to the last video, you can check it out. What about the ownership of the active business corp? The holding company owns shares in the active business corp, and we've already addressed the ownership really under the connected corporation concept. As long as they're connected, we're fine. So that's the ownership at time of sale. What about the ownership of the 24-month holding period? Again, we've got 2 companies, the holdco and the active business. In terms of the ownership of the holdco, again, same rules apply that were covered in video number 2. The ownership rules specify who can't own the shares. So for the entire 24 months prior to the sale of the shares, the ownership of the holdco shares specify that they can't be owned by anyone except you, a related partnership, or a related person. So you don't have to hold them for the entire 24-month period. If you do, that's fine. If you hold them through a related partnership, fine. But if you don't own the shares, that's fine too, as long as they were owned by a related person. So the holdco ownership tests, let's just review it in chart form. If you own them at the time of sale in the 24-month holding period, you're good. If a related partnership owns them for both, you're good. Now for your spouse, there's a little bit of a separation here that we noted, but I want to note it on this page as well. For the 24-month holding period, the spouse is related to you and can own those shares. But the only way that the spouse can own the holdco shares at the time of sale and have you eligible for the capital gains exemption is when that attribution rule applies. So it's a little different. The spouse does get a check mark in both, but for different reasons. Related person, well, obviously a related person can't own the shares at the time of sale. Otherwise, that related person would be the one getting the capital gain. So if a related person holds it for the 24-month holding period, that's fine. check marks all the way through. What about the ownership of the active business? Let's say we're going to sell the holdco shares at the 24-month mark. We have a capital gain and we want to use our exemption. When did the holdco acquire the shares of the active business? Let's say the holdco acquired them at the 18-month mark. Well, is that going to work? It depends upon who owned them for that first 18 months. If they're owned by the holdco, in other words, with some kind of a substituted share arrangement, you're fine. If they're owned by a person related to the holdco, you're fine. Or if they were owned by a person related to a holdco, you're also fine. The third bullet especially is convoluted. I thought about explaining it, but I think it really is a situation where it's difficult to remember these things. Anyway, you're going to need a tax practitioner's help if you're in such a situation. But it does matter who owns the active business before the holdco acquires it at the 18-month mark. But if it's the holdco, a person related to the holdco, or a person related to a person related to the holdco, you're fine. You're going to get the check mark. You're going to get the ownership check mark in the time of sale and for the 24-month holding period. Test number 3 is control. Well, you know what? That's really easy because we've covered these rules twice now. Just for review, both companies in both time periods have to be Canadian-controlled private corporations. Which means what? Which means as long as either corporation is not controlled by public corporations, non-residents, or some combination of both, we're going to be fine. One nuance to note, and that is, yes, the active business corp has to be a CCPC at the time of sale. Yes, the active business corporation has to be a CCPC for the entire 24-month holding period. Even during the first 18 months when it's not owned by the holdco, it still has to be a CCPC. If both companies are CCPCs at the time of sale and during the 24-month holding period, boom, you pass the control tests. You're going to get a check mark in both boxes. Okay? What about test number 4, the use of assets? Well, we know the language. We've seen it enough. All or substantially all of the fair market value of the assets must be used principally in an active business and carried on primarily in Canada. That was the test for active business assets. Now, if we're talking about the time of sale, let's carefully note a couple things. 90% of the fair market value of the assets of the holding company have to be used principally in an active business at the time of sale, and so do 90% of the fair market value of the assets of the active business corp. Right? So the 90% test applies to both companies at the time of sale. And that's how we get the first checkbox. But what about the 24-month holding period? Well, there's a conditional test, often called the modified asset test. How does it work? Well, if the holding company has a 90% FMV number, then the active business corp only has to be greater than 50%. But there's a second possibility. If the holding company can only manage to be greater than 50%, you're still fine as long as the active business corp can meet the 90%. So there's really two options, either 90-50 under option 1 or 50-90 under option 2. That's the modified asset test. Once again, if you have a holding company and you're contemplating a transaction, you need to get out there and get yourself some tax help, because it does require fairly in-depth analysis to make sure that one of these two options does hold for you to qualify. And that's how you get the check mark in the 24-month holding period checkbox. Now, using a holdco is viable, as we've seen. Certainly we can structure it in such a way that we sell a holdco, we can qualify for the capital gains exemption. But just because it's viable, is it favorable? Should it be used? Is it a preferred structure? We're going to address that in an upcoming video. I am John McElroy. I appreciate you watching these videos. I can be reached at 905-267-1043. Love to hear feedback. Give me a call, leave a comment. If you like the video, click the like button. Sure would be appreciated. Hopefully you're enjoying these videos, and meanwhile, I'll see you in the next video.